The inflation number overall is higher than what we're told. I think anybody recognizes that that's been living the life. Inflation is a major concern to the government, but not a concern enough to advocate in the way that you think the Fed is doing it, because we're about to see tariffs hit home. They're going to cause inflation to rise. And we're also seeing them add another $5 trillion to our debt. And people just going about like, so it's 40 trillion. Who cares? You better care, because there's coming a point now, and we're seeing it trade in the bond market, that even with economy slowing down and things looking better, interest rates really can't drop a lot. That is because people concerned not only about inflation, stagflation, that there'll still be some inflation even though the economy weakens, but the ability to pay the interest. And I am telling you, you're a young enough person that you're going to see one day headline news about alarming concerns. Can the United States government pay back even its interest? It's probably still a few years away, but it's something in a lot of people's lifetime they're going to see. And that's a subject, as the weeks and months go on, look to have more discussions, whether with me or others, because that's the untold story right now, is how fast we're moving towards that, which it just 10 years ago was a lifetime away. Now it's within reach. And if this government, which clearly you can rave about Trump doing some things, but this government is only accelerating debt and deficits as a whole. And we really don't have much more time to allow that without it really coming the crisis that America ever faced economically. First of all, when the market originally cracked, I actually felt for the first time in quite a while that the market had a good chance to have a very strong counter-trend rally, which as of today, I wrote that I thought that rally, which has occurred, is reached its peak, and that if I was long, I would, by the end of the day, not want to be long. So it didn't come as a big surprise. It was overblown to the downside on the trade stuff. People just have to understand there's an entire generation, almost half of financial advisors now practicing weren't even born when I started in the early 1980s. So there's an entire generation that just thinks you buy dips and markets always go up. So it's going to take a lot more than just one decline to eventually keep the stock market down. And that's another thing you got to keep in mind. And then on the other hand, who would have thought that we'd be thinking, well, gold's come down to all the way to 3,300. Yeah, I think we don't lose sight of that, especially when less than 18 months ago, we were struggling to see if we'd get above 2,000. So I think those are two perspectives is when you talk about both those separate markets to keep in mind. Now, of course, everybody that's watching would want to know, where do you think it's going? Well, first of all, anyone that makes a living out of looking in a crystal ball, trust me, you only come an expert on how to eat a lot of broken glass. So neither you or I or anybody you will interview, no matter what they claim, knows. What we can do is try to make some educated guess here. We do know that the stock market is still somewhat a resemblance of places where people buy and sell part ownerships of businesses, and businesses depend on economies. But that has changed radically over the 40 years. When that used to dominate participation in the stock market, now that's an afterthought. Half the money that's in the stock market's in passive funds. It's simply people placed it with a management group in order to track an index or an indice. And they're not actively trading, nor is the manager buying and selling individual stocks on their own merit, but just in order to track an index. And of that remaining half, 2/3 of it's trading through some computer algorithm program, which may just trade on words in a headline to some very sophisticated trading. And only a smaller percentage of all those three is what the stock market used to be, places where people are buying and selling part ownerships of businesses. So the economy, while important, isn't as directly impacting on the stock market as it was 40 years ago as well. And I think those are a couple of things we have to remind ourselves, that especially those of us that go back 40 years, that this isn't our dad's or mom's stock market anymore. This is a unique, highly sophisticated, technical, casino-like atmosphere. We even have things where still 98% of the public or professionals don't even know. We have things that are now called black pools, where large financial institutions are trading large blocks of stocks between themselves. We never see those trades. So we're not even seeing all of the activity that the stock market's generating like we used to at one time before. So there's a lot of things that are important there. And of course, on the gold market, I guess the people that are still not pleased with the move in gold are people like me that own a lot of junior resource stocks that haven't participated. Because if they're clients like yours that just bought bullion a few years ago, they should have you down for a special Christmas present this year, or at least got one this past year, because it's been a phenomenal move. It has outperformed stocks and bonds for 25 years. So give credit to those that have gone to the physical market. And quite frankly, it's not cheap anymore, but the reasons that drove gold here, which we could discuss, are still very valiant. And that's why I think after an inevitable correction, there's still a lot higher prices to go on the gold market. My attitude to the stock market is probably somewhere in the middle of what you said there. I am not one that's looking for a huge downfall of 50% or some crazy, crash-like atmosphere. What I do think is important is I don't think it has a lot of upside potential. Certainly not to give you the same chance of above average returns that the last few decades has given. And why that's critical is because there are a whole set of people still to this day in our planning group, 7 to 8 out of 10 families that come in to see us, from everyday workers to some very, very wealthy people. And I still occasionally hear from an athlete or two that I used to deal with a lot. They are living at least one lifestyle, if not more, above where their finances are. And part of that is they've grown accustomed to above average returns, including from the stock market. And their plan is still based on that above average return continuing. And so it's not so much if the stock market goes down that people should be concerned, but if it doesn't go up. Because as it goes flat, which I think my call this year was either side of unchanged, with a bias lower. And over the next few years, lower to maybe a little bit above where it's at. I don't think we're going to see anywhere the performance. Well, when you go and look at, especially when we see people's plans that were already done by somebody else, and we see their projections for the next 3 to 5 years, they were still based on above average returns. And people are living those lifestyles on the expectation that's going to happen. So I really think one of the attitudes people should take is it's not how much you make, it's how much you don't lose, which is going to separate the winners from losers going forward here. And that preservation of capital now is more important than capital appreciation. And of course, people can remember that's what gold's primary purpose was. It's been great that it's been a great capital appreciation tool, especially in the last 18 months, especially for me, for someone that got out of stocks and bonds in 2021 and bet on gold going up a lot. But let's not lose sight of what gold's historic and main purpose should be. I'm singing to the choir, obviously, and that I think is a more appropriate time for people. For the first time in maybe my entire career, I now view silver in the same breath as gold. And so I think when we do talk about metals, we need to talk about owning gold and silver now. There seems to be a camp of the dollar still staying relatively strong. And I argue with that. And that's why I'm such a big believer in the BRICS and moving long before this trade war came out. You and I know that I was speaking about the world is moving away from the United States in more ways than one, including commerce and monetarily. And there is a woman who was pretty close to Trump, and she's done economic advising, and she's banging the drums on a gold bond that we may see one as early as this July. We do know now that the U.S. banks come July 1st, tier 1, gold's as good as anything else, and that in itself has some advantages for gold ownership. So the argument for the dollar is also hurting if you're going to cash because of how it could deteriorate more. Now, of course, for us, gold is priced in dollars, but for others that are in other countries using those currencies, they've seen some good gains on the currency exchange. I wouldn't play it for a currency exchange. I think people don't recognize how much more inflation is than what the government tells us. I think people do realize they're just upset that the government doesn't demonstrate that. There's no way that inflation is just going up 0.2 or 0.3 of 1% a year. Wherever you live, I don't care what it is, anything to do with household, insurance, car-related, home-related, clothing, food, business expenses. We're getting a 20% raise in our electrical rates here in New Jersey next month. So I think the other argument that you have to keep in the back of your mind is the the great purchasing power that gold has demonstrated. It still buys today what you needed to buy 100 years ago, 500 years ago. You can't say that about any currency, especially the dollar. So don't lose sight of that. We all got caught up because we've had this really implosion. But why did we have the implosion? Why has gold done what it's done? I think we've discussed that, and I think we're going to pretty well see more of that play out in front of our eyes over the next 12 to 24 months. Well, let's take the two separate ones. We'll take miners, and then we'll take the most riskiest, the junior resource market, because there's news there as well. We do know now that many of the producers now are, we like to say, printing cash, because their free cash flow from the difference of what their cost is to bring out an ounce of gold and what they're able to sell it for is just at record levels. And this free cash flow is just dramatically increasing at a time when many other industries are seeing flat to down earnings. And that is attracting the generalists. The people that normally don't play gold stocks are now coming to that market. But what people should take notice, and it's the first time, in fact, just before you and I went on, I put a few of the charts up on my own X page on how the little junior players, the highest risk, but nevertheless the ones most leveraged to higher metal prices, are breaking out. Charts are finally, after many years of bearish patterns, are moving and showing. We've even noticed the accumulation. Even when gold had its little corrective phase the last 2 weeks, those stocks used to just fall out of bed. Not only didn't fall out, some of them went up. So the mining and exploration end of the gold, silver, and copper are all still peaking, meaning moving higher. And the ones that have not moved up till now are finally starting to show that there's daylight ahead for them.